The current recovery, Steve, has been running for 116 months. So it is, in fact, the case that the Business Cycle Dating Committee at the NBER has had a pretty quiet time for quite some time. This is now one of the longest recoveries in post-war U.S. economic history. And we're getting very close to the 120 months, which was the recovery that came to an end in March of 2001.
Now, I know that you don't forecast, but tell me, when do you guys and how do you guys decide that, hey, it's time to meet, it's time to take a look at this business cycle to see that things are getting weird out there?
I mean, it's a very data-driven decision, right? This is, the decisions of when to date these business cycles are made by a committee. It's not a simple rule. It's not 2 quarters of decline in real GDP. So the committee chair, Robert Hall at Stanford University, as we observe the data, will begin to say, I think it's time for us to have a conversation. At a moment like this, when we're seeing a period of continuing growth, there's not a lot to talk about, so the committee doesn't have any reason to meet. Right, and just a word to investors who might want to key off of this decision, don't do it, because you guys will meet and decide like you did. What's the date here? September 2010. You guys decided that a recession had begun in June 2009. So you're more interested in getting it right than being first. But Jim, I think the clearer example, Steve, is that in 2008, in late November of 2008, the NBER announced that a recession had begun in December of 2007. And if you think back to what was happening in November of 2008, there wasn't much news in that announcement. So tell us how you would process, as an economist, as a guy who's head of NBER. We have this market that is seems to say, you know what, a recession is definitely coming, and the data has been pretty robust. You have, 4% unemployment, 3.9% unemployment, GDP at 3%. What does the literature say about how to think about, does the market have it right, or does the economic data have it right? Right. I mean, as you've said, right, the difficulty right now in reading the tea leaves is that the real economy looks reasonably strong. The market saw some gyrations, especially in the fourth quarter. The difficulty with the market, which does have some information, right? I mean, the market's trying to tell us about future earnings, and it's trying to combine that with some future discount factors. We only get one piece of information, which is market values. So it's very difficult to take apart whether the market's reacting to lower prospective cash flows, which might, of course, be related to some slowdown in the real side. And you can think of many factors for why that might be happening at the moment, versus we think that discount rates are going to be higher, and consequently the market valuations are coming down. My late colleague Paul Samuelson said that the stock market's a leading indicator. It's called 9 of the last 5 recessions. Right. And I think that false positive element is worth keeping in mind. And in this particular case, when discount rates are relatively low, relatively small changes in discount rates can lead, as we know, to substantial changes in asset values. So I think that in an environment like that, it makes it all the more difficult to take apart the market valuation movements and then try to back out from them. What is this telling us about the recession likelihood?
It's a great point, James. It's Kelly here, and I have a related question on that. So we've talked to Steve a lot about how the first quarter, because of the shutdown, might go negative. If something happens like that for kind of technical reasons, how would you guys think about? I mean, look, it's unlikely it would go 2, but let's say, because the rule of thumb is 2 quarters of negative growth equals a recession. Well, is that true when it's not really the end of a business cycle?
Well, Kelly, that's a great example of where the 2-quarter negative rule could, in fact, get you into some difficulty. Right? This shutdown, of course, begins at the beginning of a quarter. So the way in which a shutdown today would impact 2 quarters of growth, you'd have to have a very, very long shutdown for that to happen.
Right.
But imagine you had a shutdown. Right. Imagine a shutdown started in the middle of a quarter, and it was a larger shutdown than we've seen at the moment, and it really did have very substantial effects on growth numbers. You could see a situation in which a shutdown ran from the middle of one quarter to the middle of the next. The growth numbers in both quarters ended up slightly negative. And I think it's conceivable in a situation like that the NBER committee would say, as long as there was reasonable growth before and after, this was an aberration. It was not a true recession, and the committee might decide not to call that. Whereas if you were simply using a mechanical rule of 2 quarters of decline, you'd be forced to say there was a recession taking place.
Jim, we have an ongoing debate here, the extent to which recessions are or these days person-made, rather than sort of outside, just happen as a shock to the system. You have the shutdown, you have the trade tensions, and I'll never forget the line that you guys put in the 2001 recession announcement that if not for 9/11, there wouldn't have been a recession. So two questions here. Do expansions die of old age? And two, what does kill them?
I don't think there's much evidence that old age is a high mortality factor in this case on its own, right? And so the fact that we are today 116 months into a recovery doesn't, in my mind, necessarily raise the likelihood that anything's going to go down the other way in the immediate term, right? And I think the statistical evidence, by and large, bears that out. The combination of man-made and natural factors, I think, can come together and probably is the more likely source. Now, some of them, you could have a very, very harsh winter or something like that might impact some aspects of things. A lot of factors are, in fact, human-related. The Federal Reserve, of course, is often a source of some downward pressure that tends to bring business cycles to a downturn.
Okay. Yeah. Jim, I'm sorry we haven't had time to talk about your really interesting research on retirement and finance, but we'll have you back. I don't know how much we actually want to see you because it's usually a bad sign, but thank you for coming on today, Jim. Jim Poterba,
Great to talk to you.